Minus 30%. That's the number the Federal Reserve quietly asked 32 of America's biggest banks to survive. A 30% collapse in residential home prices, 10% unemployment, and commercial real estate down 39%. Now, this didn't drop last week. The Fed published it back in February. Quietly, of course. No press conference, no headline on CNBC. They slipped it into their annual stress test and moved on. For months, it's been sitting there in plain sight and almost nobody covered it. And of course, why would they with the on-again, off-again war, trillion-dollar IPOs coming up and interest rates that are continuing to rise? So why am I bringing it up again today? Reason is because it looks different to the way it did in February. Now, here's what that model looks like. The Fed modeled this housing crash back in February, and right now, millions of retail borrowers are sitting on their hands waiting for the rate cuts to fix their problems. One side of the system is waiting for the rescue, while the other side is bracing for the opposite to happen. Of course, that looks like interest rates increasing. The CPI that happened this week told us exactly which way we think it's going to go. Today, I'll walk you through the inflation number that just locked in the Fed's hand, the stress test that proves they're bracing, not rescuing, the new Fed chair confirming the rescue mindset is gone, and the 18-year cycle that says all of this was supposed to happen right now at the peak of the cycle. So if you haven't already, hit the like button, subscribe to the channel, and if you want the full framework on the 18-year cycle, the 3-part mini course is linked in the top of the video description. Absolutely free. Go grab it now. Let's start with the promise. Back in 2024 and 2025, the Fed delivered 3 rate cuts. The narrative wrote itself. Relief is coming, just hold on. Rates keep falling, affordability comes back. That was the emotional contract that we were delivered. Wait for the cuts and your mortgage maths gets better. So people held. Buyers held, sellers held, renovators held, except the maths never came back. The 30-year fixed mortgage is sitting at 6.5% as of June 4th, and it's climbing back towards 7%, not falling towards 4%. A median income household can now only afford 78% of a median priced home. First-time buyers are just 25 to 30% of the market, when a healthy market runs at 40%. Single-family construction just dropped across all 7 market types the NAHB tracks, the first time that's happened in nearly 3 years. The market essentially is just frozen, and everyone standing in that freeze is waiting for the same thing. Now, here's the numbers that just made that wait almost impossible. The May CPI print came in at 4.2% year on year. Yes, we heard it, it's 4.2%. That's the highest reading in roughly 3 years. CPI is basically inflation. It's the cost of living, groceries, rent, gas, the whole basket, tracked month over month. 4.2%. That was the expected number, so they knew about it. You'll hear analysts say it was priced in, so it doesn't matter. Priced in only means traders expected the number. That's it. It does absolutely nothing to free the Fed's hand. The market expecting a fire doesn't put out the fire. It's still there. A 4.2% reading mechanically blocks a cut, whether Wall Street saw it coming or not. So let me walk the explanation through. Cutting rates injects liquidity, stimulates borrowing, stimulates demand. When inflation is already at a 3-year high, a cut pours fuel onto the exact fire they're fighting. We've all heard about this stuff before. So with the headline inflation at 4.2%, the door is locked from the inside. And it gets worse when you look underneath. Energy is up 23.5% year on year, gas up 40%, driven by the Strait of Hormuz disruption. Core CPI is softer at 2.9%, but over 40% of the basket is now running above 3% compared to just 18% before the pandemic. This is not a one sector story. What's happening with real wages? They're down 0.7% over the year. People are falling behind in real terms while they wait. Markets aren't just doubting cuts anymore. The CME FedWatch tool is pricing a 96% chance the Fed holds on June 17th and a 63 to 70% chance of an actual rate hike by year end. That's actually just gone up recently. Goldman Sachs withdrew its 2026 cut forecast entirely on June 7th. JP Morgan is forecasting hikes into 2027. The 2-year Treasury is trading at 4.15% above the Fed's own target range. The bond market is telling you the truth, and the truth is the cavalry isn't coming. And here's where it stops being theory and starts being behavior, because the people running the system aren't just refusing to cut. They're actively preparing for the opposite. So this is signal 1, the stress test. What is the stress test? Strip away the jargon, and it's the Fed asking one question of the biggest banks. What happens if all of this breaks? It's a fire drill. And the scenario they chose for 2026 is labeled severe global recession. I read the doc and the numbers are actually quite scary. Residential home prices down 30%, commercial real estate down 39%, unemployment hitting 10%. This is what they're saying. We'll see what actually happens in the market, of course. Now, here's the distinction that matters, and I want to be precise. This is not a prediction. The Fed is explicitly saying that these are hypotheticals, but that's exactly what makes it more interesting, not less. Institutions do not build elaborate models for scenarios they consider impossible. A stress test reveals what the people running the system quietly consider the plausible outer edge of the risk. The choice to model minus 30% on housing specifically in 2026 tells you where their head is, and the cracks underneath it are already lining up with it. Now, just because they're modeling 30% doesn't mean that's what's going to happen, but they're looking out for the worst case scenario at this point. Home price growth on the Case-Shiller index slowed to just 0.7% year on year, down from 3.4%. That's down quite a lot. Mortgage applications for new purchases fell 10% in a single month. Consumer delinquency risk just hit 12.6%. That's the highest since early 2023. Multi-family CMBS delinquencies are sitting near 7%, up from basically zero a couple of years ago. Adam is flagging high-risk clusters in Florida and California. The deceleration isn't a forecast either. It's already in progress, which begs the question, couldn't they cut if they really wanted to? This is signal 2, and the answer is no. Here's why. Inflation has now been above the Fed's 2% target for 5 years straight. That's the defining constraint. Now, they could cut. It's not going to end up very well if they do, and we'll see what happens in the years to come. This round of inflation is supply side, driven by an energy shock out of the Strait of Hormuz. Rate cuts cannot fix a supply shock. They can only amplify the demand side of it. Core PCE, the Fed's preferred measure, is re-accelerating at a 4.1% annual rate. The 10-year Treasury is above 4.5%, and the mortgage rates track the 10-year, not just the Fed funds rate. So even a theoretical cut might not lower your mortgage. The maths simply won't let them. And now layer in the human signal on top of the maths. Kevin Walsh was sworn in as the 17th Fed chair on May 22nd. Why does this voice matter so much? Because the institutional mood just shifted with him. His nomination alone back in January triggered an 11% single-day crash in gold and a dollar rally because markets instantly repricing for a more hawkish regime. His Senate confirmation was 54 to 45, the closest in modern history. And listen to how he thinks. I'm quoting him directly now. Once you let inflation take hold in the economy, it's more expensive and harder to bring it down. That's his entire framework. And he's probably not wrong about that. He's basically shouting he will not blink at 4.2%. But we'll see what happens in the coming months. He wants to shrink the balance sheet faster than Powell, tightening conditions even without a hike. His first major hire authored the Federal Reserve chapter of a structural reform blueprint. And here's the irony. He was brought in, supposedly, to give the White House lower rates. We've all heard that before from Trump, haven't we? And he walked into 4.2% inflation and a bond market demanding the exact opposite. Walsh isn't positioning to rescue a falling housing market. He's positioning to restore credibility on inflation, and that requires the opposite of a rescue. So now, let me pull the curtain back all the way, because when you put these three things together, you'll start to see the whole picture. Signal 1, CPI at 4.2% is the lock on the door. A cut is mathematically blocked. Signal 2, the stress test shows they're bracing, modeling minus 30% housing while you wait for a relief. Signal 3, Walsh confirms the rescue mindset has left the building entirely. 3 independent signals with one conclusion. Millions of borrowers are making real decisions to buy, to hold, to renovate, anchored to a rate cut that's already been delayed out of 2025 and is now being repriced out of 2026. Meanwhile, the institutions running the system are quietly stress testing for negative 30% home prices and 10% unemployment, two realities running in parallel in the same economy, in the same week, and most people only know about one of them. Now, before we wrap this up, let me tell you this is exactly what the free 3-part mini course is built to explain. Part 1 walks you through the 18-year cycle and the 220 years of data behind it. Part 2 shows you exactly where we sit in that cycle right now. And part 3 is how to position for what comes next. It's completely free, and the link is in the top of the video description. Now, here's the part that reframes everything you just heard, because if you've been following this channel, you know we know none of this is random. It's right on schedule. Real estate moves in roughly 18-year rhythm. About 14 years up, a peak, then a sharp decline into the bottom. It's happened for over 200 years. Land prices lead, credit stretches to the limits, and then it turns. Now, watch the receipts. 1991, 92 was the bottom. That was around that recession. The run-up took us straight into 2006 as the peak. We had the catalyst of the collapse in 2008, housing down 20 to 35% nationally, over 50% in some places like Phoenix and Las Vegas. Then around 2012, the bottom was confirmed. Now count forward, 14 years up, 2012 lands you in 2026. The research consensus puts the peak window at around 2026, and that's exactly where we're standing right now. So a Fed quietly stress testing for a negative 30% housing decline isn't reacting to a surprise. That is precisely the late cycle behavior the framework predicted on schedule. Everything is moving right on cue. Once you see the cycle, today's signals stop looking like chaos and start looking like a clock. Now, I've said this before, tops are a process, they're not a single event. I'm not telling you the whole thing collapses tomorrow. This can take many months to play out, and I suspect it will. But the sequence is in motion, and that's confirming exactly what the framework laid out. And here's the thing, this isn't just America, because the same clock is ticking on the other side of the world. Look at Australia, look at the UK, same lock, same trap. Inflation is still running hot above target, and the RBA has hiked 3 times in 2026, all the way back to 4.35%, completely unwinding the relief borrowers got in 2025. Cuts aren't coming in Australia either, not until inflation is firmly back in the 2 to 3% band, which isn't forecasted until mid-2027. And the strain is already showing. As of May, nearly 30% of Australian mortgage holders, around 1.55 million people, are now classified at risk of mortgage stress. That's nearly double the long-term average of around 16%. And the turn, I think, has already started from the data that we're seeing. CBA is forecasting Sydney down 6% and Melbourne down 7%. That's a city average, and we've already seen some of these prices come down with the latest data out from Cotality. Auction clearance rates hit 52% nationally, the lowest since April 2020, and in Victoria and New South Wales, actually lower than that. Household debt is sitting at roughly 210% of disposable income, among the highest in the developed world. The 18-year pattern is global, and Australia is just a few ticks behind on the same dial, with prices already falling. So here's what to actually watch instead. We're going to watch the Home Builders ETF. We've been watching that for several years, and we're beginning to see signs of weakness within the home builders sector. That is the first important part to watch. That is going to give us a lead on the market. Next, we're going to watch to see how inflation continues to play out. We're going to watch to see what happens with interest rates through this scenario of inflation rising and interest rates remaining below the inflation rate. That's going to give us a bit of a lead on what they're going to do about mortgage rates. Now, if mortgage rates don't come down, this is just going to keep kicking that can down the road, or get to a point where the everyday person just can't afford it anymore, and those delinquencies we talked about start to really kick in. And if you're in the market for real estate now, if the numbers don't work, meaning that you can't stack the property and you have to extend yourself too far, that is a warning sign to you not to over leverage yourself at the peak of the cycle. So really, don't do anything stupid at this stage of the cycle. Leave that for the bottom of the cycle, but we'll talk about that more in future videos. I'll see you guys at the next one, and until then, take care and peace out.